Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing TC Energy stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. TC Energy is an energy company based in Calgary, Alberta, Canada. It develops and operates energy infrastructure in Canada, the US, and Mexico. The company operates three core businesses: natural gas pipelines, liquids pipelines, and energy. The natural gas pipeline network includes 93,000 kilometers or 58,000 miles of gas pipeline, which transports 25% of North American natural gas demand. The liquids pipeline division includes 4,900 kilometers or 3,000 miles of oil pipeline. It ships 590,000 barrels of crude oil per day. The energy division owns or has interests in 11 power generation facilities with combined capacity of 6,600 megawatts. The company was founded in 1951. TC Energy is the largest shareholder and owns the general partnership of TC Pipelines. That ticker is TCP. We're going to look at the ticker that trades on the Toronto Stock Exchange. The ticker is TRP.TO. The company also trades on the New York Stock Exchange. The ticker is TRP. Let's get started with the model. This is a large cap company, 48 billion market cap. They're trading at $51 a share, and they have 940 million shares outstanding. Let's look at the financials. Since we're looking at the ticker trading on the Toronto Stock Exchange, everything in this video is in Canadian dollars. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has negative free cash flow every single year. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they have positive and growing net income each year. Revenue is the sales for the company, and it's pretty steady from 2017 to 2019, then takes a little dip in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales for the company, and below that is cost of revenue. They were able to cut their cost of revenue quite a bit, which is good. It helps them become a little more profitable. So even though their revenue was really low in the trailing 12 months, their gross profit was almost the highest. So they're doing a good job at managing expenses. Below gross profit is their operating expenses. Then below that is operating income. They have their highest operating income in the trailing 12 months with the lowest revenue. In Yahoo Finance, the numbers aren't perfect, because if you take the gross profit minus the operating expenses, it doesn't equal 6.6 billion. The operating income is correct. It's just in Yahoo Finance, they don't list every single line item, because Yahoo Finance is mapping the company's 10K to their database, and not every line item matches perfectly. So they lose some information in that mapping process. The company has quite a bit of debt, so they had $2 billion of interest payments on their debt. Below that is the other income and expenses that are not tied to the company's core business. This usually includes investments and impairments. Then of course they have to pay taxes. So they do have healthy net income every single year. And it was 4.3 billion, which was higher than previous years. You can see the company has really healthy net profit margins, 22% way up to 42%. Net profit margin is net income divided by revenue. It's how well the company converts revenue into profit. So they're becoming more efficient each year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Oil and gas companies have high CapEx because the equipment is very pricey. So you can see that CapEx was higher than their operating cash flow. That's why they had negative free cash flow every year. You generally want to invest in a company with positive free cash flow, but if they have negative free cash flow due to capital expenditures, that may be a good thing because they're investing in their company to grow it later on. So in the future, they may have much higher free cash flow. The company issues a good amount of stock to run their business, $500 million in 2017, then $1.2 billion, then $250 million, then $100 million. Since they have negative free cash flow, they're also using debt to run their business. They issued $8.1 billion in 2017 and paid down $7.1 billion. So they added $1 billion in 2017. Then they added about $3.5 billion in 2018, another $2.5 billion in 2019, and about $2 billion in the trailing 12 months. So they need to fund their business on debt and equity. This article mentions TC's increasing investment in CapEx. This article mentions the building of the Keystone Pipeline is adding to their CapEx. So you can imagine building a pipeline is very expensive, but once this is complete, it will drastically improve the company's revenue. The most important part of any business is their operating cash flow. If you don't have positive and consistent operating cash flow, you don't have much of a business, because you can't rely solely on debt and equity to run your business in the long term. The company had $7 billion of operating cash flow, and to calculate operating cash flow, it's net income, which is $4.9 billion, and then you have to add or subtract the non-cash items from the income statement. They passed through a $2.6 billion depreciation expense. That's a non-cash item, so we have to add it back to the statement of cash flows. It looks like they passed through a $990 million gain, so we have to subtract that out. So even though they reported $4.9 billion of net income, they actually generated $6.9 billion of cash flow. Of course, the investments in CapEx, as we saw earlier, were more than a $6.9 billion, so they had negative free cash flow. But it's good to see that they're generating positive operating cash flow. Let's look at a capital structure. $32 billion of equity, $50 billion of debt, and they have $49 billion of net debt. Net debt is total debt minus cash. And they're pretty leveraged. 61% of their capital structure is debt. And their WACC is 5.8%, which is a blend of the cost of equity and cost of debt. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year that's $124 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $105 billion. We divide that by 940 million shares. And we get a calculated stock price of $111. They're trading at $51, so they're trading at a 54% discount. It's a strong buy according to the model. Simply Wall Street is way higher than me. They're at $233 a share, so they're saying the stock is even more undervalued. Based on all the company's investments in capital expenditures, they're expecting their future free cash flow growth to be even greater than what I'm projecting. The stock was fairly steady for a few years. It looks like it peaked in February and March right before the crash at about $75. And it's come down quite a bit, so it looks like it's at a really great value according to my model and according to Simply Wall Street. The company's dividend has been up and down. It was 57 cents a share, then they dropped it down to 42 cents, then back up to 65. Now it's sitting at 61 cents. But they pay a decent dividend yield, 4.5%, and their payout ratio is 52%. The way you calculate payout ratio, it's annual dividend payment over net income. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $16,200. If you did not reinvest the dividends, you'd have $15,500. The company has a pretty low beta, 0.71, so the stock moves less than the market. It's not volatile. The stock has gone down 23% in the past 52 weeks, much worse than the S&P 500, which went up 14.5%. And the 52-week low is $47, the high is $77. The stock is trading below its 50-day moving average and below its 200-day moving average, so it's on a downtrend. When the 200-day moving average crosses above the 50-day moving average, that's called the death cross. That's a bearish signal. And the stock is fairly liquid. There's 3.5 to 6.5 million shares that are traded each day. Almost all the shares outstanding are on float, so they're available to investors. Institutions hold about 72% of the company's shares, and a short percentage is pretty low. Under 4% of the shares are shorted. Capital Research owns over 8% of the company's stock. RBC owns 3.74%, then Vanguard, then BMO, then T. Rowe Price. Let's look at their financial ratios. The average PE in the market's 11.9, the median is 14.4. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 11.3, so they're a little better than the average. This means investors are paying $11.30 for $1 of earnings. Price to sales is stock price over sales per share. They're at 4.7, so they're between the median and average. Price to book is stock price over book value per share. They're much better than the median and average. And the way you calculate book value per share, that's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have $32 billion. But tangible equity is $12.2 billion. So that means they have a decent amount of intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense, so they can cover their interest payments almost 3 times. ROE is net income over equity. They're at 13%, a little better than the median and average. Current ratio is current assets over current liabilities. They can only cover 60% of their current liabilities with their current assets. And their current assets are $1.4 billion of cash, $2.6 billion of receivables, and a bunch of other things. The company will need to take on more debt or equity to run their business over the next 12 months because they're not well capitalized. Their free cash flow in the trailing 12 months was negative $1.4 billion. Their working capital is negative $5.2 billion. Plus they have to pay $2.2 billion of dividends. The best way to look at ratios to compare them to similar companies, I've done videos of 44 midstream companies, and this is the average for all the companies. TC has a higher PE and price of sales, but they have a much better price to book. Their current ratio is really bad. They're doing better in ROE, they're average in debt, and they're much bigger than the average company, $36 billion compared to $7.5 billion. And they do pay a small dividend relative to the average. So to summarize, I have them trading at a 54% discount because it seems like they have a lot of projects going on which will really increase their cash flow and revenue. And this is not a fly-by-night company, it's a $36 billion company. So I have a good amount of faith they're going to execute these projects. And they have a ton of operating cash flow. Also, their ratios look okay. Let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.